All right. Good morning, ladies and gentlemen. Thank you for joining us for the third episode of Fintech Fireside Asia. It is a monthly online talk show where we bring you the brightest minds from the fintech space from around the region and sit them down for a casual chat. My name is Vincent. This show is produced by the Fintech News Network and made possible thanks to Finastra. Today, we're joined by Khairil Abdullah, the CEO of Axiata Digital, which recently secured Malaysia's largest fintech investment round from Great Eastern at 70 million US dollars at the valuation of $320 million. During the same press conference, the group announced its ambition to build Malaysia's first unicorn. And today we'll be talking to Khairil about his company's ambition for that coveted title and Malaysia's noticeable gap in producing unicorns compared to our neighbors. Thank you for joining us, Khairil. Welcome to the show.
Hey, Vincent. Great to be on the show. How's everything?
Great. Glad to have you here. Now, before we begin, I'd just like to remind the audience to feel free to ask questions at any time. I'd like to keep the session interactive and organic. So, whenever you have questions, we'll just try to address them as we go along. You can just comment in our YouTube link and we'll take it as much as we can. Now, let's jump straight into it. I'd like to start by addressing a question that's on the mind of many of our audience members. So, when we started promoting the show, there were some comments on social media who felt that maybe Axiata or Boost Holdings shouldn't be labeled as a unicorn in the future because of your listed heritage. Do you agree with this characterization, Karen?
Frankly, for me, it actually doesn't really matter whether we're labeled as a unicorn or otherwise, right? It is actually not about the title. It's not about the label. It's about creating shareholder value. And I think when we announced the Great Eastern deal, I think as you mentioned before, we did talk about the unicorn valuation. I think that's it kind of a nice catchphrase to attract the attention of perhaps the press corps. But what we were really sort of gunning for was creating shareholder value. And so if we do achieve a valuation of 1 billion, for us, it will potentially attract us to other partners, right? Beyond Great Eastern, that would be willing to partner with us to take us even further, right? So the goal is not so much to achieve that label. The goal is to find different partners that may want to work with us, right? So if there are those who are out there that say, we probably don't deserve to be called a unicorn, I'm okay with that. Completely okay with that.
I mean, at the end of the day, it's what value you bring to your users and your shareholders and stakeholders and whatnot. And on that note, I think a lot of people within the startup ecosystem, they tend to look at unicorns as a milestone for whether or not the country has a vibrant ecosystem for startups, right? So in Malaysia's case, where we don't actually have a unicorn yet, do you think that's an important milestone for Malaysia, or it's just a vanity metric that's not really necessary?
I think it's important. It's not a vanity metric. I think it's important from the perspective of generating enough interest in the market, right? Truth be told, right now, by and large, Malaysia is to a certain extent a side note in the overall Southeast Asia investment scene. And because, like you said, we haven't actually kind of generated large enough tech startups with the kind of valuations that we were just talking about. So I think if we do want to attract those kind of investors, there must be some sort of a story sitting behind it, right? If there is a unicorn type company that we're about to that we are able to close, then it then attracts those investors to find out what exactly is the story here, what's the play here, right? And then it will then create a lot more sort of investors that might be interested in startups in Malaysia. So it is not just a vanity metric. I think there is some real substance to it.
But I mean, with the age of decacorns, right? I wonder if the unicorn labels even attract investors anymore these days.
It's funny you should say that, right? So I don't know whether you know this, but there are only 7 companies in Bursa Malaysia right now that has a valuation of above 10 billion US dollars. Right. And all 7 companies are either regional or global in nature. By the way, Axiata Group is not a decacorn, right? It is once upon a time it was, but I think over the last few years, when the generally speaking, the telco market has been really sort of under pressure, it's actually dropped below the decacorn mark, right? So in that sense, then, these labels, they're all exciting, they're all attractive. But again, we have to kind of look into the context of Malaysia, right? Malaysia is not a market that on a standalone basis is at the scale that can generate that kind of valuation, right? And actually, just on that note, I was just looking at it, right? There are only, out of the hundreds of companies that are listed on Bursa Malaysia, only 7% are of unicorn and above status. So it's a very, very small population of companies that can actually achieve those kind of valuations, right? So it's hard. It's going to be very, very hard if you're sort of a pure play in Malaysia trying to achieve that valuation.
I think, really you have to look at the total addressable market, right? But why doesn't Malaysia have any unicorns yet? Like, what are the barriers faced by our startups? Because, markets like Hong Kong, markets like Singapore, they aren't necessarily larger than the markets that we have in Malaysia, right? So why is it that these countries are able to produce so many unicorns, and we are nowhere close to having our first one, and even struggle with our listed companies as well at that valuation?
I think it's a little bit what I said before. I think the companies in Hong Kong, the companies in Singapore, the ones that actually I'm familiar with, they're not playing in the Singapore market alone, right? In fact, in most of the markets that most of the startups that have achieved that kind of valuation out of Singapore, it's because it's of a regional presence, right? And largely there is enough emphasis and focus on the biggest market in this region, i.e. Indonesia. Plus, their presence in Thailand, in the Philippines, and some of the other big markets. Malaysia as a standalone market is relatively small. So if you do the math on, if you like, kind of the profit pool of whatever industry that you're in, then you very quickly realize that unless you're able to scale to the other markets, it's very, very hard to justify the unicorn status, right? It's not so much a barrier to entry per se. The barrier to entry is probably a barrier to entry to enter other markets, but it's really about sort of Malaysia as a standalone market, right? So the question then becomes, is Malaysia the best base for you to then scale up regionally? There are things that you would learn and building up in Malaysia that you can actually then replicate and transfer to the other markets as well, right? So those are the kind of questions that you would ask. I think it's going to be different by the different sectors, the different segments, the different kind of products and services that you provide.
Sure. Funnily, there was the exact same question from the audience that we just answered. So,
Yeah.
let's move along. So you're talking about justifying that $1 billion valuation, right? So let's just maybe take a step back and look at Axiata Digital and your digital financial services. So of course, those from Malaysia who's following your journey is familiar with the Boost business, the Aspirasi business. But for those who's tuning in, who's not from Malaysia, maybe you can give the audience a bit of a breakdown in terms of the digital financial services that you guys do, and what other things you are looking to add on in the near future to justify that 1B valuation you're looking at.
Yeah, so if you go back to kind of how, when we started this journey, we recognized that there is a segment of the population in our markets, and when I say our markets, I'm referring to kind of the Axiata footprint, right? There's a large segment in our population of our markets which are largely either unbanked or underserved, but that smartphone penetration is relatively high. And, obviously we recognize that the technology that the smartphone brings allows us to provide access to those customers, right? Provide us access to kind of create financial services products to that, right? So with that in mind, we designed a roadmap. The roadmap started with a view that we wanted to create micropayments as a starting point. And micropayments was useful because it then creates the, if you like, the transactional stickiness to the customer, and then thereafter, then layering other sort of products on top of that, right? And of course, with micropayments as well, you then start collecting a large volume of information, which you can then use for the benefit of the other kind of financial services products. So the roadmap was, generally speaking, create micropayments, get enough scale on micropayments. Don't necessarily make a lot of money on micropayments. Very, very hard to make money on micropayments. But then start layering other forms of financial services, right? So that's why we started with, in Malaysia, we started with Boost. We've achieved, I don't know, near 9 million registered users right now. But then very quickly, then started focusing on actually the SME base that we have in the merchant base, and providing micro lending and micro insurance to that. And then later on, we'll be launching micro remittance and micro savings. Now, hopefully, when Bank Negara issues its digital banking license, there's probably enough. Hopefully, there's enough in there that's going to be attractive for us to want to apply to it. And if we do apply to it, then we'll house all of this within the digital banking license, the digital banking operations.
Sure. So, I guess on that note, there's also questions about, because you mentioned that, if you want to achieve that kind of valuation, you also need to be able to look at regional expansion.
Correct.
And there's also some questions from the audience looking at your expansion plan as well. I mean, of course, in Malaysia, you found a good amount of success with Boost with the local market, but in Indonesia, you're up against like large players like OVO and whatnot. So, what is your the question is like, what's your expansion plan? What is your strategy to compete with the bigger players who are already present in those markets to build out the same kind of services in those markets?
I think if you look at where our financial services have been focused on, it's largely been on the merchant basis as opposed to the consumer base, right? Yes, we have 9 million registered users in Boost in Malaysia, but our lending and our insurance products have largely been focused on the SMEs. So as an example, we have during the MCO, during the lockdowns for COVID, we launched a micro lending product. It's a non-commercial product, by the way, for our SME merchants, and attached to that was a COVID-19 insurance package, right? So our DNA, if you like, on the financial services have been focused on that segment because we feel like there's a lot of this particular segment that actually have very little access to sort of structured financial services, right? Plus, we also feel that that's, if you like, productive lending. And if we do lend to them, there's actually a hope in hell that we might actually get our money back, as opposed to lending to the consumers for a whole variety of reasons, which you might not necessarily get your money back. And so we've been largely focused on that. Now, so if you look at our regional expansion plans, it's also been focused on that as well. In Indonesia, we stayed away from the consumer wallet battle because, as you rightfully pointed out, I mean, we have OVO, backed by Grab and Lipo. We've got the GoPay guys backed by Gojek. They're writing billions and billions of dollars in investment into the overall ecosystem, right? And of course, it's going to be very, very difficult for us to fight them. But what we did focus on was actually on the merchant base, right? So when we started our journey in Indonesia, we started by doing a lot of merchant acquisition. To date, we have close to 600,000 merchants in Indonesia. 90% of them are actually in what we call the tier 3, tier 4 categories. So this is usually single outlet, sole prop, mom and pops, not kind of the multi-branch outlet. Usually these are guys who can only receive cash, right? And what do we do for them? We open up access to the other wallets for them. There are several different wallets that are in play in Indonesia. We open access to them. And then through the transactions, we provide them with lending, we provide them with insurance, we support them with some of the B2B payments that they would need to do as well, right? So our focus has actually, again, been largely on that sector. Rest of the markets that we have, I think we of course we want to go where Axiata is. We don't necessarily want to go where Axiata isn't, right? So if you look at kind of the Axiata Group, we have a wallet in Cambodia. It's called SmartLoy. We have something in Sri Lanka as well. In fact, actually, our first financial services, our first banking experiment was actually in Sri Lanka. We bought a small bank in Sri Lanka, tried to do a lot of the things. In fact, we built our tech, right? Our, if you like, light core banking platform, cloud-based core banking platform, and tried to implement it in Sri Lanka. A lot of the experimentation was done there. And then more recently, we were awarded a mobile financial services license from the Bank of Bangladesh. So those are the markets that we are now sort of looking to expand into, right? But obviously, in all those that I've named, the big market here is Indonesia, right? Very, very sizable market.
But I guess like if you have 600,000 merchants, that means there's still quite a bit of a journey because it's a really large market.
It's a very large market, yes, yeah. Yeah.
So,
But maybe if I can just add on to that, I mean, 600,000, there's still, you're right, it's a very, very large market. And, there's probably a few more millions to go before we kind of hit critical scale on that. And we will continue to push on that. But at 600,000, there's already enough of a base for us to monetize, right? So, imagine that we lend to 10% of that base. That's a very large loan book that we will be servicing, right? And that will make us a fairly large, albeit very small ticket size, but a very large financial services institution in Indonesia.
So just out of curiosity, because you mentioned that obviously you would focus in markets where Axiata is present to kind of leverage off existing infrastructure, so existing networks that you've built, existing stuff. But are you also looking at markets where there are conducive environments for your kind of business to operate, whether from a consumer viewpoint, a merchant viewpoint, or a regulatory viewpoint?
We won't venture too far, by the way. So if I mean, of course, we've been speaking to partners in places like Brazil, right? And it's a great market, massive market, very similar in many regards to some of conditions in, say, Indonesia and whatnot. But it's way too far away, right? So we won't venture that far. I think our focus is largely going to be in Southeast Asia, South Asia, right? So where we have certain familiarity with the market, where to some extent the Axiata name is a little bit known. Because the other thing I was going to add, in those markets where we don't have a presence, we would be looking to partner with someone. We won't go in alone, right? So we would want to look for a local partner that has certain characteristics that we, within the Axiata Group, is providing to our tech startups, that we will be looking for the local partners to be able to do that as well.
What about markets like Philippines, who recently said they're going to kind of unveil their own virtual banking framework? Is that some kind of market that the group would consider as well?
Yeah, we would, but again, I think only if there is sort of a real partner that a local partner that we can be working with, right? Now, one of the things that is always sort of in the back of my mind is whether there's sort of enough resources, right? Not just financial resources, but also kind of human capital to be able to go after all these opportunities, right? Because in order to be able to achieve that or justify that unicorn value proposition that we talked about, the unicorn status, I think number one, of course, is that you have to be building solutions and products that are solving the customer space pain points, that you do have a business and operating model that can solve those customers' pain points and yet generate the positive unit economics, and also very hard to replicate to a certain extent. But more importantly, that you can do this and scale this across your market and across multiple markets sustainably in a very short period of time. And when you put all that equation together, you go like, shit, I need an army of very talented, capable people, right? And so when you put when you think about the opportunities that are out there, there are. But you just need to be sort of balancing them to ensure that you don't sort of spread yourself too thin, that where your focus on has enough sort of sustainable strength, if you like, robustness, before you venture too far out, right? So that's why we're a bit conservative. We work with markets that we're a little bit more familiar with, that we have kind of a local partner in the form of the Axiata operating company, because then it actually de-risks our push, de-risks our investments a little bit.
Wonderful. And speaking on that note, like, of course, there's many ways to get talent, right? And one way that companies that are well funded do it is that they start to acquire companies. So in line with that, there's a question from the same member of the audience. Dave is asking if you are looking to acquire smaller fintechs to complement your digital banking aspirations.
The answer is yes, and there are a few term sheets out there right now. I probably can't go into too much detail, but yes, we are, right? And acquihire is not something that we're not used to. I think if you go back to the history of Axiata Digital, when we started scaling up our edtech business, right, we did a very major acquihire, and that's worked out very well for us. And so we are looking at M&As to actually help us bolt on certain capabilities or give us access to certain segments of the markets that we aren't able to build organically.
Wonderful. I guess we will be receiving a press release on that soon. Yeah.
Hopefully. Yeah.
So, on that note, because beyond creating value for consumers, stakeholders, of course, profitability is a very important measure as well.
Mhm.
And we're looking at a lot of the sort of challenger banks in the UK struggling with this issue of profitability, right? Especially when the next round of funding is difficult to come by. So a lot of these neobanks are kind of starting to charge fees they didn't previously charge. So they're starting to look less and less appealing compared to even some of the incumbent banks as well. So
Mm.
that's kind of in line with Stuart, who's kind of asking the question of, like, there are a lot of these banks that are not profitable yet. What is
Mm.
your plan to profitability for the group?
Oh, so I think if you look at the different parts of the
Mm.
business right now, so on the micropayment side, yes, we're not profitable there. It's very hard to make money in that particular product line. MDRs, merchant discounts rates are razor thin. It's in some cases zero. Actually, in many cases zero. And one would argue that actually it's probably negative because there's some subsidizing involved in getting the consumers to spend. And on top of that, you add on things like kind of your cash in costs, and if your cash in cost is from a physical offline, you have to pay a nice spread on that. If it's from the banks, the banks will charge you for that. If it's from credit cards, you get whacked with a very large charging rate. And then on top of everything else, the scale and the expansion requires a very high acquisition cost, a very high retention fee. When you do all of that together, you realize, oh, wow, shish, like it's going to be very tough for you to make money around that. Having said that, though, I think if you take the Malaysian market, I think there are signs of market consolidation. And when I say consolidation, I don't necessarily mean M&A in the market per se. What I mean is that the market share is now shifting to a smaller number of people, right? As opposed to being as fragmented as it was before, right? And I think you and I have had conversations around it, right? Like there's kind of like in the telco industry back in the early days, right? Now in the micropayment space, there's sort of the emergence of the big three, right? And the big three are now commanding a pretty sizable share of the overall market. And when that happens, then there is some normalcy in the market, right? That there are some less crazy practices, if I can call it that, that then allows us to maybe not make money, but not lose so much money, right? So that's micropayment.
A little bit at least.
Stem the bleeding, exactly. But then what's very interesting is when you start looking at the other parts of our business, and our micro lending business is actually profitable. And I would sort of, I guess the reason why it's profitable is because, well, first of all, the interest rate environment in Malaysia, and even though we practice very strict responsible lending, the interest rate regime is attractive enough that there's enough headroom, right, for you to charge decent interest rates, charge decent, if like, fees. That then allows you to make money, right? As long as your NPLs, as long as your defaults are under control, and our defaults, so far has been sort of very much under control, right? So I remember in the early days we were panicking a little bit because our default rates are relatively high, but then you realize that actually you need to train your machine, right? It's a machine learning credit card scoring engine, right? You need to provide it with training data. If there's no defaults in your training data, then the machine will know how to kind of decide which ones to give and which ones not to give, right? So there needed to be some amount of losses that we had to take on. But if you look at it today, our default rates are sub 2.5%. In fact, actually prior to COVID, it was much lower than that. Obviously, as with COVID, some of the micro SMEs, they basically had to shut their business, their operations, and so we are starting to see a little bit more defaults. But outside of that, our default rates are still very good. Our cost of disbursement, cost of distribution, cost of collection is near zero. So net, the marginal cost of our operation is actually very low. And given the interest rate environment, it's no surprise that we are actually able to kind of make money in that particular business. Microinsurance is, of course, relatively new for us. With the partnership of Great Eastern, we're starting to launch these if you like, sachet insurance products. We're learning a lot of different things about it, around kind of how do we ensure that there's retention, there's rollovers, there's repeat buying, and so on and so forth. But by and large, once you acquire a user and you are able to do that, that in itself is actually very profitable as well. I think Stuart's right. The person who asked the question, Stuart, right? I think Stuart's right in the sense that as you start scaling up, are you then going to be forced to lend to customers that your machine will say, hey, no, you cannot lend to, because there's a very high probability of default? I think we have to kind of maintain very strict discipline around that. So, if that means actually putting some stoppers around our ability to achieve the 1 billion valuation mark, maybe we will actually impose certain disciplines around it, because we don't want to scale to a point where we're providing lending to segments of population that will definitely default. We don't want to scale to a certain point where we're selling insurance products to people who don't really want them, right? So we're going to maintain some discipline around that.
So I guess the other dimension to that is also a lot of these neobanks that we look at, they are primarily trying to earn their income from the consumers, right? Therefore, you see all these fees coming up. So as opposed to your model where you're more focused on the SME aspect of things, micro lending's part of things. But as a follow-up question, and your micro lending business falls under your Aspirasi umbrella, correct?
Correct. Yes.
And how big is that loan book? Like, are you able to share with the audience?
Let me just 1 second. I was just asking. You know what? Like, I knew this question was going to come up, and so I was asking. The guys, right? So it's $40 million right now, year to date. So US dollars, not ringgit.
Right.
Yeah. So it's not massive yet, but it's growing.
What's your projection in the medium term, like maybe in the
so
next...
we're trying to grow that loan book to about 500 million within the next 2 years. And if you kind of draw a straight line on sort of our growth trajectory right now, that seems possible. But again, I always caution my teams, right? How many of the segments that we're not quite willing to lend to today will we be forced to lend to if we want to have a $500 million loan book, right? So that's kind of something that we have to sort of keep in mind. It also means that we have to train our machine with a lot more different sets of data, which may mean kind of going into markets where we don't have the data right now, but we'll have to find partnerships that actually gives us the data to then try and experiment and figure out which segments will be good to lend to and otherwise.
Wonderful. And to follow up on the insurance aspect of things, I guess one of the main factors why insurance is attractive is an attractive sector in Malaysia is because the underinsured is very high, right?
Correct.
So how much of that kind of partnership with Great Eastern and the investment plays into your next strategy? What kind of insurance services are you looking to introduce? What kind of gaps are you trying to fill? And how are you using your ecosystem to fill these gaps?
Yeah, so I think you mentioned that the insurance is actually very underpenetrated in our markets today. It's funny when you talk to a lot of the folks out there, the people who are potentially buying these products, right? They want protection. They don't know insurance, right? So there's a little bit of a kind of a mismatch right there. That, as an example, if you go to the East Coast in Malaysia, and that every other year there'll be floods, the storms will come towards the end of the year. There'll be major flooding, loss of property, destruction of property, loss of livelihoods, and all that, right? And so when you talk to the folks out there, right, then and you tell them, hey, why don't you go and buy this insurance package? It'll protect you, and so on and so forth, right? But they don't get it. Right? They don't understand why do I need to pay this fee, and if something happens, I might get it. But they definitely want protection, right? They want protection from that kind of loss of livelihood. So I think there is a little bit of a mismatch around kind of the communication that needs to happen together with kind of serving their needs, right? Now, obviously, these are segments of consumers or segments of customers, I should say, that's sort of way below the if you like, way below the kind of the profitability mark for traditional insurance companies. I mean to say that if you apply a traditional agent-led selling model for insurance, right, you're never going to be able to make money on that particular segment. So we needed to do different things, right? We needed to do use technology a little bit around our distribution, around our disbursement, around our communication, but also for us, because we're doing it for the SME segment, try to bundle it or package it with a lot of the other things that we sort of offer with them, right? And so that they can then actually experience this initially in their minds are free, right? But over time, then starting to sort of see, hey, look, I actually need this protection, and so I'm willing to pay that monthly premium, which, by the way, it's 2 ringgit, 3 ringgit, 5 ringgit, right? Very, very small premiums on a monthly basis to get that kind of protection. One example is sort of key man risk, right? We call it key man risk, and essentially what it is that if you imagine you're a char kway teow seller, right, in a street corner somewhere, and you fall sick, right? Hopefully not from COVID, but you fall sick from, just the normal common cold, and you're out for about 5 days, right? Now, when you're out for that 5 days, it's actually not so much the medical bills or and whatnot that hits you, right? Because actually the government's done a good job, MOH has done a good job in providing healthcare at very, very low cost, right? But it's actually the lost income, right? And that starts hitting you because you don't make that much money anyway, and you got your bills, you got your children's education, your rents and whatnot to cover. It's the lost income that starts hitting them, right? And so we designed this product that says, hey, look, what you call it, pay 5 ringgit a month or pay 10 ringgit a month, and you get this much coverage should you fall sick, and all you need to do is you need to show an MC or some kind of certificate from the clinic, and then you'll be able to claim that, right? And that covers them for the 5 days of lost income. That's a great product. Again, that's a communication around protection versus insurance. We don't sell insurance, we sell protection.
Right, that's a nice little distinction over there, isn't it? So it sounds like to me that right now the focus is still on micro insurance and micro entrepreneurs as well. Do you see a scenario where you graduate to kind of take on things like life insurance, critical illness to consumers? What is the roadmap over here for your insurance aspect of business?
I think right now we are very focused on the SME segments. We're starting to experiment with consumers, but only again on things that are potentially synergistic to the portfolio of services that we have, right? So one of the more successful products that we have on the insurance side is bill protection, right? Again, the word protection, right? So you're paying your monthly bills, but for whatever reason you're unable to meet the deadline and whatnot, bill protection kicks in, right? And it covers that bill for you, and then you can kind of top up after that. So that's what we're sort of focusing on. We're experimenting a little bit with the consumers. Obviously, the consumers is a much larger base for us. We have around 9 million in Malaysia. If you add the Celcom user base, in Indonesia, if you focus on the XL user base, that's massive, right? The one thing, consumer insurance is actually not new to us. I think Vincent, you may know that once upon a time we invested in a company called Bima. Bima was a very large micro insurance company in the region. Actually, we still have a stake in the company, right? And they were 100% focused on on the consumer segment. So we do believe that at least on insurance there is a market for them. But I think the way we are working with our partners right now, the likes of Great Eastern, we want to become, if you like, lead generation for them. Right. We want to get it to a certain size, get them to the habit of buying these protection packages, and then move them and graduate them to the products that our partners will be able to serve them and serve them much better. Right. So your traditional life insurance product, your traditional P&A, right?
Excellent. So we don't have much time left. So what I'll do is take one more question from the audience, and then we'll kind of wrap up with some closing thoughts. So we have a question from Rizwan over here, who is the president of the Fintech Association in Malaysia. His question is quite long, half our faces are covered. Yeah.
Wow. Okay.
Wow.
Yeah, I'm trying to read it.
That's a really detailed one. Besides the technology agility, how different is Axiata Digital's business model as a digital bank in optimizing existing revenue models and adding other types of revenue touch points, for example, capital markets, given the current level of financial literacy in the domestic and regional spectrum?
That's a great question, and feel like Rizwan, we should probably catch up over coffee for this one, right? So I think short answer is we're still figuring all the parts, the components to our digital bank right now. If you like, one of the big one of the big things that we did when we built our bank in Sri Lanka is the idea that that you could actually massively reduce costs on the operational side. I'll come on to the balance sheet side, right? But costs on the operation side with the technology, right? So cloud-based light core banking system with a massive API layer that allows different sort of components or different sort of other fintechs to plug in, which is a model that we will introduce in Malaysia as well. So all the other fintechs who are on this call right now, we will be open for business. There will be avenues for you to sort of plug in into our digital bank that we can then provide that we then work with you to provide services to the customers, right? But on the capital market side, this is something that we are working with certain partners right now to try to figure it out because it's a little bit more complicated or complex an issue. Right now, if you like, the unit economics of our business model does not rely too much on the gains that we can get there. If you take, for example, right now, our existing lending business, we probably don't have the best cost of capital. In fact, it's pretty horrible because we're actually using Axiata Group balance sheet, and the WACC on Axiata Group balance sheet is really, really high. So there are probably different things that we are working with our different partners, right? Whether it's Great Eastern, whether it's some of our banking partners, to figure out more creative models to solve the balance sheet side, right? But certainly on the technology and operational side, I think we're starting to have a blueprint that would really massively bring down our unit economics of serving these bottom of the pyramid customers, if I can call it that.
So I guess that also ties in nicely to another question from the audience, which I'll just show for the last one because you kind of answered it as well. So Raj is actually asking how ready your backend system is to deal with integrating to these ecosystems. Anything to add, Jeff?
Right. So I think you may have noticed in the announcement of actually, I don't know whether we mentioned it in the announcement at all, but when we did the Great Eastern deal and we created the Boost Holdings, one of the things that we mentioned was that our API gateway business, Appigate, was going to be subsumed into the financial services business, the financial services holdco. And the reason why we wanted to do that was from day one, we were very keen on ensuring that we build, if you like, a sort of a middleware layer that allows different partners to plug in, right? And actually, whilst we're doing that, we're already talking to quite a lot of different players out there that will create products that we will never have the capacity or the capability to do. But then we give them access via API into our customer base, into our authentication systems, into our et cetera, right? And that's the things that we're sort of building right now. Again, this is not new to us. We've done that before with our experiment in Sri Lanka, and we're just bringing it here and doing it at a much larger scale.
You did announce that during your press conference. It's just that
I did, huh?
Big headline of like largest fintech investment round, right? So that's what everyone I've got distracted.
Yeah.
So, a lot of people that are tuning in today are also fintech entrepreneurs themselves, right? And they are also looking to raise their funds, whether it's a seed round or Series A or Series B.
Yeah.
What advice do you have for them in terms of courting investors and raising funds?
Wow. Okay. So I mean, it's I guess I'll take it in two. I'll answer the question in two different buckets, right? So one is around, if you like, the product and the service that you're offering, and then the two is if you like, the sort of the fundraising activity, right? So on the first side, I think you got to always ensure that, and this sounds very motherhood and apple pie, I apologize for that, but it is so fundamental to your success. I think you always have to be focused on ensuring that you are in fact building solutions and building products that are solving customer pain points, with a business on an operating model that can generate positive unit economics. That's not something that's very easily replicable, and that you can then do this at scale across multiple markets and do that, at lightning speed, right? It sounds motherhood and apple pie, but it's damn difficult, as many of you will know, right? Very, very difficult. On the fundraising side, now, unless you have people on your team who have experiences and the connections, right? One of the advice that I'll give you is to go hire an advisor, or maybe find someone who you are open and willing to partner with. You might have to give him 1, 2, 3% of your equity, and then sort of task him with going out to do that, right? You don't have to hire an investment bank. And in fact, actually, at your size and your scale, none of the big boutiques will actually want to work with you anyway, because, if you're looking to raise 10 million, the amount of money that they'll get for them, it's not worth their time, right? So you're not going to be able to find that. But here's the beautiful thing about our markets, right? There are a lot of these individuals who are potentially ex-investment bankers, folks who have done some kind of fundraising before, folks who have some relevant experience, and they can offer their services to you. Some of them, by the way, might want to become seed or angel investors in your personally invest in your company. But those are the guys that you might want to kind of reach out to, and they're not too difficult to find. If you're really interested in finding some of them, I'm sure if you reach out to me, I can kind of connect you to one or two of them, and then they can help you, right? And to a certain extent, obviously for us, in the early days, we used a little bit more, but we are now at the size and the scale. It's probably easier to attract people. But in the early days, we definitely did use one or two of these individuals, and they definitely did help.
Wonderful. And I know I've said like the final question for the last two questions, but interesting questions. So let's not let it go to waste, right? And then we'll wrap up. So we have a question from an insurer over here, the CEO of an insurance company.
Oh dear.
I thought it was a good question. I thought it would be a nice note to wrap off on. So he's asking, like, how has it been to work with insurers so far? Insurers are quite technologically backwards in general. So is it a case of them being product providers and the rest is been taken care by you? How far can this go?
Yeah, so I think we all very clear on sort of what roles, right? And again, it comes from years of tuition, right? With Bima, we found how Bima struggled to work with the underwriter themselves, because obviously by and large they were a distribution company, right? And we learned a lot from that. I think and maybe kind of this is a plug for Great Eastern. I mean, they've been fantastic, right? I think what they recognize is they don't know what they don't know. But there are certain things that they do know, and they're probably much better than us on those kind of things, right? So we work with them on co-creating the products. And it's amazing how flexible that they've become. I don't know whether you guys realize this, but prior to announcing the equity deal, there was actually a commercial partnership that we signed with them last November, and basically from the start of this year, we've been experimenting a lot with them in co-creating products, and that's very, very difficult because usually insurance companies will take 9 months maybe to develop a new product. We wanted a new product to come out in 2 weeks, right? And so there's been quite a lot of a learning process for both sides. But I think we're now at a point where it's working very, very well. They understand the rhythm of the kind of business that they were in. They understand the value that we bring, in the sense that we are looking at a distribution model that's so different from the traditional agent-led model of selling insurance. They recognize that we are able to kind of go out there and tackle segments of customers and segments of consumers that they will never be able to tackle. We on our side recognize that we don't understand the detailed intricacies of the underwriting part of the business, and so that's if you like, kind of the symbiosis that we've sort of now found ourselves sort of working in with them, right? So it's a great question, Rohit, and it kind of we went through, if you like, sort of 9 months of learning, and once in a while we still get on these steering calls, and there will still be sort of things that we have to trash out on the table to kind of make sure that we are actually in sync in what we want to do, what they want us to do.
I'm sure you've had very long conversations with the risk and compliance team on this speed to market.
Very true. Very true. Very true.
We've unfortunately ran out of time. Do you have any closing thoughts you want to share with the audience before we go?
Well, if the audience is a bunch of sort of fintechs out there, then my message to you is that I think this is a very, very exciting time, right? Forget the ambition of sort of the unicorn and whatnot for a second, but recognize that actually, because of COVID, we are moving into a digital-first new norm. any report that you read about contactless and about a cashless, contactless sort of transaction will mean that if you are providing a service that does not require a face-to-face interaction in closing the product or the selling of the product and services, then chances are you'd be able to sort of build a business around it, right? So I think this is a very exciting time for us. It's unfortunate that it's coming in the back of a global pandemic, but you should see it as kind of the role that you will play in providing product, services, solutions to the people who are in need in a post-pandemic digital first new norm.
I think it's quite poignant, right? Like the first fintech revolution was brought on by the previous crisis. Perhaps the second revolution will be brought on by a separate crisis.
Mm-hmm.
Well, with that, it only leaves me to thank you for taking your time, Khairil, in joining us and sharing your thoughts with us today, and to thank the audience for taking the time to tune in. We hope you enjoyed the session, and do join us for the future episodes as well. Thank you, and have a good day ahead.
Thank you, Aaron. Thank you.